They weren't losing money, they were losing control. Revenue was still growing, customers were still buying, market share was expanding across every major region. From the outside, it looked unstoppable. But buried inside the balance sheet was a mechanism most investors never noticed. And when it triggered, the empire didn't fade, it snapped. This is what happens when leverage, the same force that builds billion-dollar dominance, turns into the weapon that destroys it. And if you understand how this works, you'll never look at rapid corporate growth the same way again. The company scaled aggressively. New markets, new acquisitions, new distribution channels. Revenue doubled in 3 years. Margins expanded. Analysts upgraded the stock repeatedly. Headlines called it visionary execution. Investors called it disciplined capital allocation. But growth at that speed requires fuel, and companies only have 3 ways to fund expansion: revenue, equity, or debt. Revenue wasn't enough to move fast. Issuing equity would dilute ownership, so they chose the most powerful accelerator available: leverage. Debt doesn't just fund growth, it multiplies it. Instead of waiting 5 years to acquire competitors, you buy them now. Instead of slowly entering new markets, you dominate them immediately. Instead of defending position, you expand territory. And for a while, leverage feels like genius. To understand what happened next, you need to understand one concept: the capital stack. At the top sits senior secured debt. Lowest risk, lowest interest, first to be repaid. Below that, mezzanine debt. Higher return, higher risk. At the bottom sits equity. Founders, shareholders, the people who think they're in control. When business is strong, everyone wins. But when pressure builds, the order of power becomes clear. Debt gets paid first. Equity absorbs the shock. The empire wasn't built on cash reserves. It was built on layers of obligation. Every acquisition added another layer. Every expansion introduced new repayment schedules. Every refinancing pushed risks slightly further into the future. On paper, it was efficient, optimized, strategic. In reality, it was tightening the margin for error. Because leverage doesn't just amplify returns, it amplifies fragility. Here's why it felt safe. Interest rates were low. Credit markets were generous. Revenue projections were strong. Refinancing old debt with new debt was easy. Extending maturities looked prudent. Rolling obligations forward became routine. The stock price climbed. Analysts praised capital efficiency. Return on equity improved, and leverage quietly increased. Then the environment shifted. Interest rates rose. Credit tightened. Investors became cautious. Suddenly, refinancing wasn't automatic. Debt became expensive. Cash flow projections narrowed. The same leverage that once accelerated growth now required heavier interest payments. Margins compressed. And hidden inside loan agreements were covenants. Covenants are conditions, financial thresholds companies must maintain. Debt to EBITDA ratios, interest coverage ratios, liquidity minimums. As long as those numbers stay within range, lenders stay quiet. But when they drift too close to the line, power begins to shift. The company missed a leverage ratio target. Not dramatically, just enough. Technically minor, strategically enormous. Because covenant breaches trigger clauses, and clauses give lenders leverage. If ratios aren't restored, lenders can demand immediate repayment, increase interest rates, or impose operational restrictions. The empire didn't run out of customers, it ran out of flexibility. Here's something most people misunderstand. A company can be profitable and still collapse. Profit is accounting, liquidity is survival. On paper, earnings remained positive, but short-term obligations were growing faster than accessible cash. When debt payments come due, you don't pay with optimism, you pay with liquidity. The company had assets, it had brand recognition, it had revenue streams, but it didn't have enough flexible capital to absorb tightening conditions. So they did what leveraged companies often do. They sought emergency financing. But emergency capital rarely comes cheap. To stabilize the balance sheet, they issued new equity at a depressed valuation, which means existing shareholders were diluted, ownership percentages shrank, voting power shifted, board influence rebalanced. The CEO who once drove expansion now negotiated from weakness. Lenders demanded stricter oversight. New covenants were introduced. Operational decisions required approval. Leverage had flipped direction. It no longer amplified growth, it dictated control. Credit rating agencies downgraded the company's outlook. The stock dropped sharply. Confidence weakened. Suppliers shortened payment windows. Counterparties reassessed exposure. Because financial systems don't collapse all at once. They tighten, gradually, then suddenly. The board convened. Not because revenue disappeared, not because customers vanished, but because capital control shifted. And when capital shifts, leadership often follows. The CEO was asked to step aside to restore confidence in the markets. The architect of expansion removed during contraction.
Leverage isn't inherently reckless, it's efficient. Private equity firms use it deliberately. Corporations use it to enhance return on equity. Investors reward disciplined debt usage. In stable conditions, leverage is powerful. But leverage removes room for error. When macro conditions shift, when interest rates rise, when refinancing tightens, debt doesn't negotiate. It enforces, mathematically. And mathematics doesn't care about vision. Why does this cycle repeat? Because leverage rewards boldness during expansion. Executives are praised for aggressive growth. Investors chase higher returns. Markets celebrate dominance. But risk compounds quietly. Each layer of debt narrows flexibility. Each refinancing extends exposure. Each optimistic projection assumes stability. When stability disappears, the structure strains. The company didn't collapse because demand vanished. It collapsed because flexibility vanished. And in corporate power, flexibility is survival. Debt increases return on equity until it erases equity. Control doesn't belong to the loudest leader. It belongs to whoever controls the capital structure. Because when leverage builds your empire, you feel strategic. When leverage traps your empire, you become replaceable. So here's the question. If leverage can accelerate domination, but also accelerate loss of control, would you still use it to win your market? Or is control worth more than speed? Every empire eventually faces the same decision. Grow faster with borrowed power, or grow slower and keep control. The difference isn't ambition, it's who holds the leverage.